Welcome to Value Investing webinar. Every month we come to you for insights on value investing, and today we are going to talk about how to find value in growth markets, in your markets which are primarily known for growing rapidly, spotting values and how to spot them. Uh, in 1984, Warren Buffett, in his famous Columbia Business School speech, uh, what turned out to be a classic read, which is the Superinvestors of Graham-and-Doddsville. He said they search for discrepancy between value of a business and price of small pieces of it, and pieces of that business. In essence, that is what value investing is. So it sounds so simple, finding the gap between the worth of a business, finding the worth of a business, and whenever it is available at a big gap from that business in the small pieces, what happens in the market every day, that turns out to be an opportunity for him. And for long, but it's far easier said. The nuances of doing it, executing it, spotting values, and turning that into a big opportunity. How to go about doing that? More so in a market like India, which is primarily known for companies which are small, which turn big. That has been the mainstay of our markets. That is what we are going to discuss now with Saurabh Gupta of Quantum Mutual Fund. So welcome, Saurabh.
Thank you.
So a big job in terms of finding value in a growth market. How difficult it is?
So it's when are you asking this question? If you're asking me this question right now, it's not so difficult. Had you asked this question about 6 months ago, it was difficult.
It was difficult.
It was difficult because there are times when the market is in momentum and beyond fundamentals, and we need to understand what a value manager tries to do. A value manager is simply trying to arrive at an intrinsic value of a stock. To various valuation methodologies and taking a discount to that for a margin of safety and buy that stock and make a return out of it. So whenever the market structure does not allow him to do that, it's the time when the value manager have difficult time and he might underperform. So what kind of market structure? So as I explained, when the market is in momentum, market is not respecting the risks adequately, is factoring too much of the growth or expecting too much of growth coming in. But as a value manager, we are not trying to pay that kind of premium to growth. Those are the difficult times for a value manager. But
so that underperformance primarily happens because you are scared to invest and market is going up rapidly.
Scared would be a strong word. I mean, we would not be scared. Just that it's not part of the philosophy. It's beyond the philosophy.
It doesn't fit in your framework.
Exactly.
So you will either be in cash or not in.
Right.
Not fully invested.
So as the portfolio stocks move towards their intrinsic value, we'll try to trim and sell. And if you don't see opportunities because the whole of the market has moved up because of the momentum and the earnings have not caught up and the valuations are expensive, we tend to have more cash. Until the time that momentum continues, the cash will be a drag on the returns. But the positive side here is that since we have a lot of cash and since the momentum, whenever it breaks, we can deploy very quickly and we go less than the market itself because we have cash and we are not into those momentum stocks. We fall less, and then from there on, when we deploy cash and the market rebounds, we tend to outperform. So for longer periods of time, 5 years, 7 years, 10 years, you see that outperformance keeps coming back.
So coming to the heart of the issue, which is India is a growth market. We know that the biggest charm of Indian market is that small companies turning big and making a lot of money for investors. How difficult it is for you to function while that is the general, the underlying theme of the market?
So I'll start a reply with this disclaimer that we are not averse to growth. We are just averse to paying what kind of premium do you want to pay for that growth.
Okay.
We are not ready to pay the premium because we are not sure whether that growth is sustainable, not sustainable, and we need to build a certain margin of safety. So at times it is difficult. So periods, as I explained, when the markets are in a very strong bull market, the periods like 2005 till 2008 or periods like CY17, where the stocks just ran up because of reasons of more liquidity reasons rather than the earnings growth reason. Those are the times we face difficulty, but it's simply we go back to our research process, we go back to see if we are making any mistakes in terms of earning growth or valuing those companies. And when we test check those assumptions, and if those assumptions we believe are okay, we will sit back, we'll sit back and we'll wait for a price to come. And eventually the prices do come. Yes, there are some sectors where it's been difficult. So for example, I feel consumer staples is one sector, very difficult to find value in India. Stocks trading at 45, 50 times, 55 times.
And they remain like that for many
For
years.
many years. For the past, I think 7, 8, 9 years, we don't have any consumer staple in our portfolio. So there would be pockets which do not correct, and it remains very expensive. So those kind of stocks do not come into portfolio. But rest we see.
How much of a compromise is that?
So
In terms of diversification of your portfolio, or missing on an opportunity?
So definitely those stocks have done well. Expensive have become more expensive. But our philosophy remains that capital preservation is also equally important as return. And even after not buying those stocks, we have done pretty well in terms of outperformance, because other opportunities keep on coming. So, and opportunities do come. So if you look at pharma, for like 6 years we did not have any pharma name, but suddenly things went south, and then we got opportunities and got into pharma. So pockets do emerge. Similar is the story with these non-banking financial companies. So they had a terrible, great bull run. And in October, then people realized there are risks to the balance sheet, risks to the liability side of these companies, and nobody was factoring those risks. We were factoring those risks and arriving at a value, and when these stocks came to value, we definitely. So it's a wait and watch, and focusing on what we are doing.
So how difficult it is internally? How do you tackle it in terms of, that you are seeing things not working out your way? It could be a test of patience. You have your watch list and all your parameters ready. And how frustrating it gets at times?
At times, yes. So internally, we keep on deliberating, debating the valuations, the earnings, going back to the companies within the research team. So we have a very detailed research process, and we have a large team of 10, 12 analysts who cover different sectors. And every Wednesday, there is almost a day-long meeting where you deliberate on each stock, each sector, whichever is presented, and just going back to the research and the basics. That's the only way out. And there are prolonged periods of time where we don't get new stocks, but then I've seen that we get windows of opportunity. So February 2016 was such an opportunity when China scare was there, and we were able to bring our cash from 20 to 5% in a matter of days. Similarly, October 2018 was such opportunities. So so at that point in time, we need to have conviction, and because our research processes are strong and we believe in that philosophy, our conviction is strong at that point in time, and then we deploy cash and manage to do well on longer periods of time.
The narrowness of the market in terms of liquidity, we have 60, 70 stocks where I find that, most mutual funds, dominant part of their portfolio is concentrated in those. So how problematic is this breadth?
So problem in the sense that we see it more from a liquidity perspective. So there are 7,000 odd companies listed in BSE, and if you apply a simple filter of $1 million daily trade, that number of stocks reduces to 450. And this 450 is because last 3-4 years the price movement has been very good. If you ignore that price movement, pure volume terms, that number will fall down to 250. Right? Because to assure people of a realizable NAV, we need to be in liquid names. So that's the only filter. We don't go by market cap filter. So that's our universe. So at times, yes, that 250, 300, I think we believe that still a good universe to have, and you can create a very decent portfolio of 25 to 40 stocks.
Because everybody will be chasing it. The whole mutual fund industry will be after it.
Look, so what we've seen is that yes, but what happens is because there are different strategies around. Some would be chasing those when their momentum and their growth oriented. Maybe correction is an opportunity for people like us to get in. So what we see is that we get ample opportunities from these 250 to 300 stocks to buy and create a portfolio of 25 to 40 stocks.
Never it comes to your mind that there is a high quality company, not very liquid, and you'll be tempted to buy it because it turns out to be very compelling, but your process doesn't allow that.
Yes, there have been times and those stocks have done well, but then the only thing is that when I, by getting into that stock and getting out of that stock, the impact cost of getting into and getting out is so high that I don't want to get into that. And I need to, as I told you, we need to get into that realizable NAV. So these kind of stocks, if I add, because of my buying, sometimes stock goes up. And when there is a market downturn and people will ask for their money or come for redemption, I need to give them the NAV that I'm showing them. I should not destruct the price while selling.
Okay.
So that becomes paramount in terms of giving the what we promised to them.
But you run an open-end fund, and a good part of your open-end fund will have investors' money which will stay for a very long period of time. So what's the harm in actually having 5-10% which can actually be a little less liquid?
So your point is fair, but what happens is that reduces my scalability. In the sense, if my fund is small, say 100 crore fund, then it is fine. As I scale up, that illiquid names will continue to be large. And then when there is a redemption pressure, and it can be sharp, as seen in 2008, then it becomes a meaningful
It becomes a difficult
difference.
thing. Yeah. So, Saurabh, thank you very much for sharing your thoughts on this. We have got very few questions, but very interesting question on your strategy, and investors are asking very specific, question from you. Akshat has asked, where do you think will the next value migration happen in 2019?
So
It's already happened with the NBFC and
exactly. So we need to just wait and see where the value has emerged over last 3, 4, 6 months, and if there is a catalyst still there. So there is a correction, and you see that they are below their intrinsic value, those sectors or stocks. But you have to keep in mind that there should be a catalyst. Yeah, so for example, NBFCs, if you look at some good names which have corrected, growth continues to be there. There is a market there which banks cannot serve, right? And those companies generate good ROA, good ROEs, and seen business cycles. Right? So in a decent margin of safety, if you get into those kind of stocks, then
at reasonable price.
at reasonable price, at good margin of safety, then you will create your value. So that's value. So these value migration as a concept, we believe will continue to happen. You just one needs to keep a watch and a watch list of what kind of stocks do you want to buy and a fair value of them. And if they're below fair value, you just go ahead
Do you
and
see
buy
any
them.
sectoral trend in terms of these values emerging or the migration happening right now? Something which was value and now it is getting reasonably priced, or the price performance is visible now?
Yes, so to about 1.5, 2 years ago, if you look at technology as a sector, it generates a lot of cash. Our core ROEs are upwards of 40% for these companies. Just that the sector was in transition where the technology changes had happened and companies had to just move around to those new technologies. The companies were available dirt cheap. Those valuations were not seen 15, 20 years. So that was a spot opportunity. And for one, if you look at last 1.5 years, those stocks have moved up. So from a very attractive price, they moved to closer to fair. We believe still there is a lot of returns that have to be
Still
made there.
a lot of upside there.
There's upside, but still they are not
So technology
screamingly
underway, value
Yeah.
migration underway.
Yeah, so it's already playing out. NBFC's October was an opportunity. It started to play out because the structural story continues to be there. So that will play out.
But you'll still have a lot of garbage. The fear in the NBFC is quite real. There'll be companies which, because finance business are always, risky.
Right. So that's where your research skill lies. So whenever a sector or a market falls, everything will fall. The tide goes out, everything falls. In that fall, you need to pick up the things that you believe will move up again and have a structural story in place. So moving beyond the garbage, the quality names which would have fallen, you pick on those and you play the cycle then.
The next question comes from DK Ninama. What is your outlook for pharmaceutical sector? Very brief question. Until about 2 years back, pharma as a fund category, they used to be on the top of the pack. Now it is often at the bottom of the pack.
Right.
And it has remained top of the pack for nearly 8-9 years.
Right. So what happened in 7-8 years was that the US market was doing well for them. There was a patent cliff where generic companies were doing well. Last 1.5, 2 years, what is happening is that there is a clear pricing pressure on the generics in US, and most companies are having tough times over there. Secondly, if you look at the regulatory aspects, US FDA has opened an office in India. They are extremely proactive in going to a company, doing checks and stuff like that. So a lot of companies are facing compliance issues there. So that is second. And
They are unable to withstand the rigor of validation of quality, and
yeah,
so that's a very fundamental problem, no? Because this will actually put a question mark on the existence of these companies.
look, so if you look at the questions that are being raised, some are not something that these companies cannot do. Some are procedural issues. These are not some data manipulation issues. Though some companies have faced data manipulation issues.
That's right.
So one should be avoiding that, because that becomes a governance issue. But there are some procedural issues where they wanted to do things in a certain way and you have done in a certain other way, and that can be rectified. So clearly we believe that US focused companies having a large portfolio in US will continue to face some pressure, plus these US FDA issues. So your focus should be more on domestic stories, high on domestic stories kind of stories, or companies which have a great pipeline in US which is yet to play out. So those are the names that you should talk about.
Not the generics.
Even the generics, but ANDA pipeline should be good, where new products are coming which are better pricing. Anybody who has a legacy portfolio in US right now, they'll face a lot of pricing pressure still.
Anup has this question, that what is the average growth rate one should expect while investing in private or government-backed insurance companies? Is there any value there? So framework of evaluating or valuing, because this is a new sector. 4 years back we had no insurance company which was in the publicly listed domain. Now we have a LIC, we have the GIC, the reinsurance company, the life insurance company, and the general insurance company, which are publicly listed. So maybe it will be useful to understand that what should be the analytical framework for looking at these companies.
Yeah, so let me talk about the life insurance first. So life insurance essentially was a 100% monopoly LIC, and it still has a 70% market share. Private companies are growing faster. They are now 30% of the market. So one important thing that we looked is that if you look at premium to GDP, India is comparable to developed world. So there is no under penetration in terms of premium to GDP in life insurance in India. But if you look at coverage to GDP, which some reinsurance company give, we are one of the lowest. Thing is that insurance till date or still is in India sold as an investment vehicle, not as a protection vehicle, right? So clearly the market is shifting towards more of a plan which is more pure protective plan, which are more profitable, and these private companies are selling that.
Protection oriented.
Yeah, protection oriented. And so that's a few trends that we are seeing. So you might not see premium growth as an industry as a whole, but for private they will continue to gain market share, and we believe a 15% kind of premium growth in terms of their revenues, you can see that happening. Yes, so most of the valuations happen on embedded value, which is the present value of the business plus the future growth that the management believes. So there is an embedded value, and you attach a multiple to that embedded value
for the growth as well as the legacy.
Yeah, right. As of now, all good life insurers are very, very expensive. I think they're factoring too much of future growth. Some are correcting right now, but still we believe a reasonable discount to embedded value, or just a slight premium of growth, that should be a good thing. Not 2.5, 3 times kind of EV. That's not a number that you should look at. That's the story on the life insurance. On the non-life insurance side, there are a lot of players that have come up, and the way the regulatory structures have changed, the profitability should improve. Here the opportunity size is immense, in the sense that
bigger.
It's much larger, because it's very underpenetrated. First, because India as a country needs to create assets and then insure it. As of now, we have a lot of headroom in housing. We have a lot of headroom in cars. Right? We don't have that kind of ownership. First the ownership will come, then the insurance will come. Right? So there is a very, very under penetration, and we believe that these companies could grow much faster and will be more profitable. The valuations is something that you need to be careful about in these companies.
So general insurance, looking at I look at it from a personal finance angle, that you take a 15-year, 20-year view when you take a policy. And here everything gets renewed every year. You insure your car, and you don't hit your car. So you don't get you get a no claim bonus, and then these contracts are. So how much one should be looking at these underwriting and all, and the investment returns, and how complex it can get, or can an investor really take a very broad general view of these businesses?
Yeah, so broad general view here would be you should look at a company which can cover its operating expenses.
As an investment business, your life insurance thing, you have contracted
Yeah.
that, okay, I'll keep giving you
Yeah.
5,000 rupees every
Yeah.
quarter.
So a thumb rule here would be you should look at a company which can cover its operating expenses through incomes made out of premium only, without their investment income. So most of the companies run underwriting loss, in the sense they pay out more than the premiums they earn in a certain year.
Okay.
If a company can match that, then that investment income wholly goes to the investors of that company. So that is a much better company. So that ratio is extremely important.
That is something which one should be keeping an eye on.
Right.
Okay. But that could be pretty erratic, there could be concentration risk, or, in general insurance, you don't know what will hit you tomorrow.
Yeah, so but if you look at trends, so some companies manage risk really well. So the opportunity where you see that you can manage risk better, you go into that opportunity. You just don't go after everything. So that's the thing that the management needs to take care of.
This is a very different, very generic question, but I think this is a question which many people will have in their mind. Mukunta is asking, what is the best way to assess future financials and cash flows of a business while deciding to invest in a stock? So this amounts to writing a thesis.
Yeah. So Mukunta, what I would say is that there is no best way. There is only one way, and it's a full-time job. You need to look at historical performances of those companies, create a detailed model if you have time. So there's no shortcut to this. And then you look at 5, 6, 7 years of history, or history of how the company's performed, if it's a cyclical company over a cycle, or if it's a steady state company, how it's performed. Based upon that and your understanding of the sector, and if you are able to meet the management, you decide on how the future course of business would be, how are the competitors supposed to expected to behave, and based upon that you create a financial model and cash flow generation and profitability of this company. So as you rightly said, the answer could go on and on and on. It's a pretty long
But
process.
even the limited answer that you have given is quite scary, that meet the management, make a model. So you should really consider. But there are two parts to it. If you are interested, if you have time, inclination, do all that. Besides the return, the whole process of exploring and identifying and betting and building a conviction might be worthwhile exercise. And you have a simpler way available for a cost, which is invest in a fund. Then a similar question, but I would like to twist this question a little bit to get a sharper answer, which is Rahul is asking how one can assess the management quality of a company. So the answer could be pretty long, but can you list me 3 things which you will work on a checklist of quick 3 things to assess the quality of a business?
So one is, if you look at, so 3 things. One would be clearly what it prays or what it preaches and what it does. That's it's a great thing, that if the management is saying X and doing Y, that's a very important thing, that you can get that information through interviews or through annual report reading, management discussion and analysis and stuff like that. So that is a very important factor.
Okay.
That is one. Second, you should go through the board structure. How many founders are on the board? How independent is the board? Is the chairman independent? Are the independent directors part of the subcommittees which are created? Plus, all the independent directors are attending all the meetings. So that all information will be available.
It's all publicly available.
So that is second. And third is a little more intuitive. So when you do your research and you meet them very often, there is an intuitive sense that that you have done your channel check, and what the management is promising, is it achievable or not? Is he conservative, or what kind of management? So these are the few things that you can look at. And then there is a history, there is a tale of how he's been behaving with the minority investors and stuff like that. So these things.
The rest of it is, the smell of it.
Yeah.
So smells bad or smells
clearly
okay.
One is quantifiable, which you go through annual reports and numbers. Second is the smell of it.
Muthu Swami is asking, what is your view on mid-caps in financial sector? Should one focus on them? Are you finding opportunities there, value opportunities there?
So mid-cap financial, if you talk about non-banking financial company, we did find some value, and we believe
Not
that
banks?
no, we are not looking at smaller banks as
Okay.
of now. We believe that banks is a scale business. If somebody achieves a scale, then the scale player benefits out of that. So we believe that NBFC, yes, if you can pick up some good names, we have done so, and then there is an opportunity there. You could build upon that.
Ushma is asking that can you please give 3 quick how to points for reviewing existing mutual fund portfolio? Looks like this question comes to me. uh, there are many ways, but first and foremost, I would say that look at your portfolio and see that it is reasonably diversified, which means if you have 3-4 funds, are they multi-cap fund? So because there is embedded diversification in that, the fund manager is absolute liberty to move in any segment of the market. The moment you choose a large cap fund, you are saying that you are supposed to invest only in large caps, or you choose a small cap fund. So diversified in its nature. Then if you have 3-4 funds, make sure that it is not all of a same fund company, because sometimes they go in and out of favor and they go all at the same time. So that's number 2. Then see that on a long-term basis, and that long-term basis, I would say 3 to 5 year time frame, the fund has done better than the benchmark, and the fund don't look at 6 months, 1 year, 1.5 year return. If the fund has done better than the benchmark and is at least in the first and second quartile relative to other funds of the same kind in the same category, when you look at value research classification. And I would say that look at the broader classification. There are, when it comes to the multi-cap fund, I'm generally referring not only to the multi-cap which is stated by the SEBI, but also the value fund and also the larger mid-cap category. So if you club these 3 categories and make sure that these funds are at least in the top half, because it's not possible for many funds to be doing well at all times over across time. Funds also go in and out of favor based on their strategy, based on their selectivity, based on their emphasis. So don't take a quick call based on a short-term performance. If you do these 3 things, besides this, if you are doing 2 things on your own, which is investing regularly and making sure that it is your long-term money, which is the money which you are unlikely to need for 5 years and more is invested, you'll be okay. So Ajay has this question for you. Looks like the final question. Are contra funds different from value funds?
Value funds sometimes feel like a contra fund because generally value emerges where nobody's looking at a certain sector, but not essentially. So the focus here would be, it could be a company or a sector which is in vogue, which is not left out, but you still find value because being large part of the investor base now becoming myopic. A quarterly performance or 2 quarters of misperformance in a great story can give us give a value investor an opportunity to get
So many
in.
of the contra funds choice might translate into value as well, but it may not necessarily be a value pick.
Exactly.
Okay.
So a value strategy may have some contra picks, but vice versa, a contra pick might not be value. So that's what I explained.
Thank you, Saurabh, for sharing your insights.
Thank you for
And
inviting.
my pleasure. Thank you, viewers, for being with us. We'll come back again next month with insights on value investing.